Here's a question nobody actually answers well. Should you own Bitcoin, gold, or stocks? You've probably heard all the arguments. Bitcoin is digital gold. Gold is dead. Stocks are the only productive asset. Silver is the hidden play. Everybody has an opinion, but almost nobody explains the reasoning. And here's why. They are all comparing the wrong things. It's like asking a carpenter whether a hammer is better than a saw. The question doesn't make sense until you ask what you were trying to build. Hi, I'm Dr. Hunter Allbright, Chief Revenue Officer at SALT, a former banking executive and professor at the University of Colorado Boulder. For nearly 30 years, I've worked at the intersection of credit, analytics, and emerging technology. From leading global portfolios in traditional finance to building Bitcoin-backed lending infrastructure today. And this channel is about thinking clearly in a noisy world, understanding Bitcoin through structure, risk, incentives, and long-term value. When people first hear about Bitcoin, they usually compare it to something familiar. Isn't this just digital gold? What's the difference between Bitcoin and stocks? And why not just buy silver? Those are all fair questions, because every asset exists for a reason. Gold has been around for thousands of years, and silver has industrial and monetary history, while stocks represent ownership in productive companies. So where does Bitcoin fit in? Today, we're not going to pick teams. We're going to build a framework for you to think about this. And by the end of this video, you'll understand what gold is good for, what silver is good for, what stocks are good for, and what Bitcoin is uniquely designed to do. So let's start with first principles. Now, before comparing them, we need to ask, what problem does each asset solve? Because every asset isn't interchangeable and they all have different purposes. Gold, think of it as preservation of purchasing power. Gold has served as money or a store of value for over 5,000 years. Why? Because it's scarce, it's durable, it's divisible, and it's hard to counterfeit. Gold's core role historically has been preserving purchasing power. It doesn't produce income, it doesn't innovate, it doesn't grow earnings. It sits there and holds value across generations. That's its job. Silver, think of it as hybrid monetary and industrial asset. Silver historically has functioned as money too, but today it plays a dual role, a monetary metal and an industrial commodity. Silver is used in electronics, solar panels, and medical applications. Now, that means its price depends not just on monetary demand, but industrial demand as well. So silver is partially a store of value, but it's also an industrial input. That's what makes it more cyclical. Stocks, ownership in productive enterprises. Now, stocks are completely different. When you buy a stock, you're buying ownership in a company. You're buying future cash flows. You're investing in innovation and earnings growth. Stocks are productive assets. They generate income, they reinvest profits, and they expand. Historically, stocks outperform most assets over long periods of time because businesses create value. But stocks come with management risk, regulatory risk, competitive risk, and economic cycle risk. They are tied to the success of human enterprises. So where does Bitcoin fit in? Bitcoin doesn't produce cash flow, it's not used industrially, and it's not run by a company. It has no CEO, so what the hell is it? Bitcoin is a digitally native, fixed supply monetary asset. Its purpose is simple: to be scarce, verifiable, portable money in a digital world. That's it. And its defining characteristic is this: there will only ever be 21 million. No board meeting can change that, no government can vote to increase it, and no CEO can dilute it. That's fundamentally different. Bitcoin versus gold. This is the most common comparison. It's brought up all the time. Bitcoin and gold share several traits: scarcity, durability, no counterparty risk, not tied to corporate performance. But here's why they differ. Portability. Gold is heavy. Bitcoin can be sent globally in minutes, even seconds. You can move 10 million in Bitcoin across borders with a passport. Now try doing that with gold bars. Verifiability. Now gold requires purity verification, trust and custody, and storage validation. Bitcoin can be verified by anyone running a node. You don't have to trust, you can verify. Supply certainty. Gold supply grows about 1 to 2% a year through mining. If gold prices rise significantly, more mining occurs. Supply increases. Bitcoin's issuance is fixed and halves every 4 years. No matter how high the price goes, supply does not accelerate. That makes Bitcoin the first asset in history with a truly fixed supply. Bitcoin versus silver. Silver has monetary history, but today it's heavily influenced by industry. That means if global manufacturing slows, silver demand drops. Bitcoin's demand is purely monetary. There's no industrial use, no technical substitute, no production variability. Silver supply also responds to mining incentives. Bitcoin supply does not respond to price. That's a major difference. Bitcoin versus stocks. This is where people get confused. Stocks are investments. Bitcoin is not a business. When you buy a stock, you're betting on revenue growth, profit margins, leadership, and market share. But when you buy Bitcoin, you're not buying growth. You're buying scarcity. Stocks grow because companies innovate. Bitcoin appreciates if adoption increases. It's more comparable to monetary premium than earnings expansion. And another key difference, stocks are denominated in fiat currency. Bitcoin exists outside the fiat system. It's not just another asset inside the existing system. It's an alternative monetary network. So let's talk honestly about risk. Gold, there's lower volatility, there's a longer track record, there's slower appreciation historically. With silver, there's more volatility than gold. It's influenced by industrial cycles. And with stocks, they're historically strong over the long term in terms of growth, subject to recessions and systemic crises. And Bitcoin has the highest volatility of the group, has the shortest track record, but has asymmetric upside historically. It's fixed supply with adoption-driven demand. Now, Bitcoin carries more volatility, but it also represents a very different type of monetary bet. It's a bet on digital scarcity, decentralized monetary systems, global adoption of non-sovereign money, and that is a very unique thesis. So the question is it a store of value or a productive asset? Here's the framework that simplifies that question. If you want income, cash flow, dividends, stocks make sense. If you want a historical store of value, a physical hard asset, then gold makes sense. If you want industrial and monetary hybrid, then silver is a good fit. If you want a digitally native, absolutely scarce, decentralized money, then that's Bitcoin. They are not mutually exclusive, but they serve different roles. Now, why is Bitcoin so often compared to gold and not stocks? This is because Bitcoin isn't trying to be productive. It's trying to be neutral money. Gold did that for thousands of years. Bitcoin attempts to do that, but in a digital, borderless, and programmable way. Whether it succeeds long-term depends on adoption, but its design is clear, and clarity matters. Gold was optimized for the physical world. Bitcoin is optimized for the digital world. Stocks are optimized for productive enterprises, and silver straddles both monetary and industrial use. So the question isn't which one is best. I would posit the better question is what role do you want an asset to play in your financial life? When you understand that, the comparisons become clearer. Bitcoin isn't gold, it isn't silver, and it isn't a stock. It's a new category, a digitally scarce, decentralized money. Understanding that distinction is foundational because once you know the problem each asset solves, you stop comparing them emotionally and start thinking strategically. Now, if this has helped clarify a few things, I encourage you to subscribe to the Bitcoin Advantage. We're breaking down Bitcoin from first principles so you can make more informed decisions and not reactive ones. We'll see you in the next episode.